Hello and welcome to Moving Iron Podcast number 271. This edition of Moving Iron Podcast is brought to you by Ag Direct. No matter how you buy your ag equipment, whether it's from a dealer, an auction, or a private party, Ag Direct can help you finance it. You can even apply online at agdirect.com. Learn more about your financing options at agdirect.com. Well, once again, I've got Tanner Ehmke from CoBank here to talk with me about what's going on in the world of ag economics. So Tanner, how you doing, man?
I'm doing great, Casey. Great to be back.
I appreciate that, man. So a lot of stuff going on since we talked last time. There's been some pretty significant jumps in interest rates. The Fed's raised the interest rate about 1.5 points here over the last 60 days. As what you see happening out there, you've got some dry weather coming through. Commodity prices have taken a pretty significant drop here over the last 2 or 3 weeks. Last couple of days, you've seen a lot of getting back in, a lot of guys coming back in and buying. We've seen some pretty significant jumps up. We got this heat and some dry weather coming through the area that's kind of stirring up a little bit of a weather scare. So I guess with all that stuff going on, Tanner, what's your kind of synopsis of what you see happening right now?
I think all this combined, Casey, is the sign of the end of times.
I'd agree. I would agree with you. It feels like that some days.
This is there's a lot going on, and some people would be scratching their heads, like myself, when you see the weather scares that we've seen in the Midwest with the heat, and then the drought out in the West is just getting worse. I think I saw some temperatures in the Midwest, well, like 100 over 110 degrees. That doesn't bode well typically for plant development.
Right.
So some concerning developments there on weather across the entire U.S. almost. And one would scratch their head and say, why are commodity prices down so much? Well, there's a lot going on, as you mentioned. Yeah. And I think we need to step back, take the 30,000-foot view, and what is going on in the world of inflation in general. Mm-hmm. And I'll try to apply that, try to find some sort of logical reasoning as to what's going on in commodity markets, because it's across the entire commodity spectrum. We've seen a sell-off over the last month. Corn is down almost $2 from its peak. Yep. We've seen, crude oil come back. We've seen natural gas come back. We've seen almost anything that is a commodity has really seen a major correction here. And so, is this the sign of inflation finally peaking? Is this the sign of the Federal Reserve's actions finally having the influence, or finally having the effect that they desire of cooling off prices? Maybe not. I think there's a lot to unpack here. I'd say, first of all, you've got on the macroeconomic view here, Casey, there is some signs that the economy is cooling off, not only in the United States, but around the world, with consumers pushing back on prices. They're buying less. Yep. Our customers at CoBank are telling us that they are seeing consumers less willing to absorb higher costs being passed on from the company to the consumer through higher prices on the grocery shelf. And consumers are trading down to smaller packaging. They're trading down from brands to private label. They're buying less in general. All this is a sign of a consumer that's being stressed financially, that they finally had enough of inflation and they're not willing to absorb those costs anymore. And so perhaps if you follow that logic through the supply chain, well, if the consumer's buying less and they're going to push back on higher prices, if we're seeing inventory builds in warehouses and in grocery stores, and then those prices have to be marked down in order to move those products, then you back that all the way through the supply chain, all the way down to the farmer and the rancher, and then prices would come down for farmers and ranchers for the livestock and the crops that they grow. That makes logical sense. I think there's more going on there, though, that perhaps might defy logic. As you mentioned earlier, we got some extremely high temperatures that are going to impact crop development and reduced acreage in some areas for some crops. And I think probably in a nutshell here, what we've seen in the last month or so in the correction of commodity markets is more managed money driven.
Right.
Speculators, managed money, or hedge fund managers, etc., de-risking in commodities. They're taking their money out of commodities, and so they're not. I think that's probably the main driver there, or a major driver of it. And a lot of that is tied to energy and natural gas and what have you. And if consumers are going to be consuming less fuel, that kind of impacts a lot of other things, because crude oil is really the center point of the commodity basket indexes. Yep. So I think a lot is tied to what's going on there. But as for specifically in the agricultural commodities, perhaps there is some optimism that crops aren't as bad as, or the crop situation isn't going to be as bad as thought, because we're hearing, for instance, in Kansas, in some areas there have been some very good wheat yields.
Yeah.
Perhaps in the Midwest, in the corn and soybean country, crop conditions aren't as bad as thought. That perhaps this crop can endure some record high heat without losing a whole lot of yield potential. Remember, this is, here we are in early July. We've still got a long ways to go before we get to harvest. And so we are still trading weather markets or weather forecasts. We're in a weather market right now. So you're going to have that natural volatility. So I think there's probably some, hope, or for instance, optimism, on the crop side of things, that perhaps we're not going to be as bad off. And then there's over in Ukraine and Russia with that situation. There has been some grain moving out of Russia. I think you had mentioned that earlier, and that is true. The United States has signaled or warned a lot of other countries out there, don't buy this grain coming out of Russia because it's stolen from Ukraine.
Right. Yep.
Bottom line is that grain is moving, and that is going to loosen the global balance sheet on grain. Okay, that's going to make it less tight, a less crisis-driven market when you have that grain leaking out of the Black Sea. Stolen or not, it's moving into the market. And a lot of these countries that are dependent on this grain coming out of the Black Sea region really don't feel they have much of an option. If you're in Africa and you've got a lot of people starving, they're going to say, you know what, I'm going to feed my people, stolen grain or not, they're going to get fed. Right. And they're going to take that grain. They're going to buy the grain from Russia, whether it was stolen from Ukraine or whatever the risk is there. They've got other higher political risks of a population being not fed.
Sure. Yeah.
So taking it from that vantage point, it's hard to blame those countries for taking stolen grain. So at the end of the day, grain is moving. At the same time, if you look at a few of the other commodities out there, like cotton, for instance, has come back quite a bit. That's going to be tied directly to what happens in the stock market and the global economy. And so, as reason would have it, when you've got a global consumer that doesn't have as much wealth as they used to, they're not going to be buying as many clothes. So cotton is going to come down right alongside the energy markets and the stock market. And then what else? There was something else you brought up, Casey. We talked about conditions.
Yeah, I mean, that condition there, I think we kind of hit that.
Federal Reserve
stuff. Yeah, Federal Reserve. So talk about that a little bit, kind of what you're seeing from an interest rate perspective.
Well, it's you would think that the Federal Reserve is looking at what's going on, and they're going to say, well, we're going to take our foot off the gas on interest rates. That may or may not be the case. It depends upon the psychology, really, of Jay Powell and his feeling of inflation and the jobless rate. And when you look at those two numbers, and those are the two most important numbers, inflation and the unemployment rate, because that is their dual mandate: right. Full employment, low prices.
Right.
If you've gone to any restaurant anywhere in this country, how long does it wait for you to get your food? It's going to take a lot. It is taking a lot longer. Yeah. If you can even get to the restaurant that's open, because a lot of these places are Oh, it's because they're not staffed. They can't find workers.
Yeah.
So I don't think the Fed is at all worried about the jobless numbers going up because we are so tight. In fact, there's a lot of economists that are scratching their head on what's going on. If indeed we're in a recession right now, it is a weird one because the jobless numbers are so low. The last quarter we had in Q1 or Q2 showed showed negative growth.
Yeah.
Now, if we have negative growth again here in this quarter, well, that technically would be a recession. A recession is 2 quarters of negative growth back to back.
Right.
That is the actual definition of a recession. It doesn't, for a lot of people out there, it doesn't seem like a recession when you have so many people employed and we don't have enough workers. Typically, what you see in a recession
it's opposite of that. Yeah,
it's the opposite. You have a lot of people looking for a job, and right now you have companies desperate to try to find workers. That doesn't seem like a recession, and so I'm just postulating
more like a stagflation type of scenario. I mean, I've heard that tossed around a few times,
where prices go up and jobless numbers go up at the same time.
Yeah.
Typically, as reason has it, inflation is going to go down when job numbers go up because consumers are they don't have as much money and they're not going to buy as much, and so prices are going to drop. That's the reasoning here. But right now we're in this really weird environment where jobless numbers are really low, and they may go up, but prices may keep going up as well because the jobless numbers are still low. Even if we do have, even if we are in a recession right now. But there's a lot of speculation of whether we're in a recession right now or not. Most economists I read and listen to think a recession would be more probable next year in 2023.
Yeah,
that's
what I've read. That's what I've read a lot too. Is that recessionary thing in this? I've read a lot. I've read two. There's 2 distinct camps out there. One is you know what, we're in a recession. We're going to really see that recession take off and run September, October, November timeframe of 22, and then it's a short-lived deal. 23, we're good to go. I've read a lot of guys too where they've said that September, October timeframe is peak inflation, and by this time next year, we should see a real dramatic easing of interest rates back down because we should be quote unquote healthy again. And I guess, I mean, from an economist standpoint, I mean, what camp are you in? Because I'm just a dumb equipment guy. I have no idea what to believe. But I mean, to me, it's like I've never seen it to where it's this divided in like a hardcore line. You listen to a guy like Peter Schiff, we're off the cliff and we're dying tomorrow, and then you get guys like Rich Poston that's on the show all the time. He's like, no, I think this is a short-lived thing. This is a business cycle that we're in, and we're going to bounce back. So I guess, what's your opinion on that as an economist? I guess what are your thoughts?
I don't know. I'm more of the middle, that this is just really weird. That's my forecast. Things are just going to get weirder.
It's going to get weird. Okay.
It's just going to be, these are strange times that just keep getting stranger. So it's not like I've got any deeper insights here for you, Casey. Other than my feeling is that we're based on data. Consumers are pushing back on higher prices. Credit card usage is going up because people have run out of cash. That's not a good sign. Right now, we are seeing a lot of consumers feeling the pain, and that cannot go on forever. If we have a recession, I think that the consumer is already leading the Fed on this. Almost all recessions have been caused by the Federal Reserve by raising interest rates.
Right.
Well, the consumer right now is already feeling it. They may be ahead of the Fed, pushing back and saying, no, we're not taking higher prices. We're not going to buy as much.
Right.
Then we may see that push through the supply chains, and that may show up in reduced productivity. Consumption is 70% of the U.S. economy. Consumption is going to go down because of the consumer, irrespective probably of what the Fed does, just because inflation is so high. It's the highest in over 40 years.
Yep.
So that's kind of in my camp, because these are weird times.
Right.
I don't want to start looking at what's been done in history and trying to benchmark off of that, because I think we're in
unprecedented time. Yeah, it's
unprecedented times.
Yeah.
Whatever you think is going to happen, just take the opposite position, and that's what's going to happen.
Right. Right. Yeah, it's been on the other side. All right. So let's talk. Okay. So we're talking about prices right now. And if you take a look, some of the stuff that's driving pricing too right now, when you look at commodities, is where we're at as far as stocks go, right? Where we're at, if you look at the cattle herd, it's the leanest it's been in quite a while. There's a lot of heifers on feed right now, from what I've read, that of all time high. So if you're putting, a heifer to feed to go to the rail, you're not growing the herd, right? You're
right.
Sending it off the butcher. You look at chicken and poultry, all that stuff. You start looking at the rice to wheat ratios and where those things start to play in. The price of wheat's real high, so rice is coming back behind that. But just like everything else, rice is kind of in short supply until we get this next crop in. And what does that look like? Do you see some pressure just from a simple supply standpoint that you think could be driving some of this stuff that we're seeing, not just as much as it just because of supply chain issues and those kind of things, but just overall scarcity of world supply of grains and proteins?
Yeah, that was our situation heading into the Russia-Ukraine crisis. We were already in a world situation of tightness and on raw agricultural commodities. And with the cost of production having gone up as it is, that's probably going to impact productivity. Farmers withholding chemical applications, for instance, for weed and bug control. We're seeing that happen out there, or a lot of people are reporting that. And so that's going to be impacting productivity. In some areas of the world, tightness in fertilizer supplies. A lot of those places, it's not as bad as expected, like down in Brazil. Apparently, they've got all the fertilizer they need. They hedged pretty hard. They leaned really hard into this. They bought a lot of fertilizer out of Russia. They were able to get their hands on it, and they were able to build their supplies heading into planting later this year. So it's really this mixed bag of, I think, where we're going to see abundance in some areas, but extreme tightness in others of global commodities. And the question is going to be, can we move it around? Are we going to be able to move grains and oilseeds around the world and foods of all types? When we start getting into it, I look at specialty crops and dairy specifically. We're getting a lot of export business come to the U.S. because New Zealand and Europe, the two biggest producers or exporters, are down hard on production because of weather and regulatory constraints. That's more export business coming to the U.S. Because they're not sending those dairy product exports out there like they used to, and that's lifting global prices higher and makes us competitive. So we've got a positive story here of where we're able to meet that demand in a world of global tightness. On specialty crops, on the other hand, we've got a problem here of drought. We've got a problem of high heat, as we talked about earlier. That's going to be impacting productivity. And we've seen record produce imports in the United States this past year, or this past quarter. And that is partially due to the fact that we've lost so much production in this country because of our weather, because of disease issues, specifically down in like Florida, for instance. That sort of situation only gets worse and worse every year because of citrus greening, that disease. And so our produce imports are record high at a time when other countries are also struggling as well with the weather issues and input costs. The positive here, I'd say, amidst all of this global tightness, is that shipping rates have come down, Casey. And that means, I think, that creates an opportunity here to more efficiently move commodities around the planet from areas of abundance to areas of shortage. How long is this silver lining going to last around this cloud? I don't know. But shipping rates are still very high, historically speaking. It's just that they've come down. And I think that will be a positive for a lot of these countries that are stressed on their caloric needs, especially over Africa, Southeast Asia. They're going to be, I think, in a better position, hopefully, to get their food grains. You mentioned
Right.
wheat and rice. I think rice is the saving grace here of all of the food commodities out there. Rice is really kind of holding the ship together. That was the one of the only commodities out there that is of abundant supply.
Mm-hmm.
So going forward, I would say with all of this stuff going on with all the food commodities, whether you're talking grains, livestock, dairy, or specialty crops, rice is that one that it's holding it all together, I think.
Yeah, I think you're right. Yeah. So let's talk a little bit about India and China right now, for example. So take those two countries. There's 1.2 billion in India and 1.7 billion or whatever it is in China. So you got almost 3 billion people out of the 7 billion people on the planet in those two countries, right?
Right.
China is under this no tolerance COVID thing, and they're locking things down just tight as they can. Every chance they get an outbreak, they're locking things down, which is really messing with supply chains, but it's also messing with demand for hogs, demand for dairy, demand for those kind of things coming out of the U.S. And no matter what we do in the world when it comes to the hog supply, like China has to come in. They have to buy hogs from the U.S. in order for it to work here in the United States. I guess as you take a look at countries like that, like 2012, if you historically go back and look, you had Arab Spring and those kind of things because of shortages of food and those kind of things. Right? There's 54, 55 countries or whatever it is in Africa, and something like 65% of those countries have already had some kind of a coup attempt already in this year based around food shortages and those kind of things, trying to get the other guy in that's promising they can have more food if he becomes the leader and those kind of things. So looking at those kind of situations right now, I guess, what are your thoughts when India finally says, okay, we've already stopped wheat, we've stopped flour coming out now, and we're gonna export any more rice now to anybody. And then you really start looking at that rationing, especially in China, and China's buying a lot of that stuff from India. You start looking at those kind of things.
Yeah, and which is odd. That's
very odd. They're in a war with each other, but they're still trading commodities. That's the craziest thing on the planet. But you have this whole thing going on. I guess is if India tomorrow just says, you know what, we're keeping all the rice that we have, we're keeping all the wheat that we have, and we're not going to export this stuff into Africa and Southeast Asia like we have in the past. What's your thought there? How does that ratchet things up in not only supply driven pricing, but just overall world stability?
Well, that's exactly the problem. Rice is what's holding a lot of these countries together from food crisis.
Yeah.
And if India, the number one exporter that has been subsidizing all of their exports for a number of years now, they've been building up their rice inventories and wheat inventories, but really rice is the one that is really ample in the supplies right now. If they were to do like they did with wheat, then we've got a serious problem. The countries that would be the greatest, or the regions of greatest exposure of that double whammy, if you can put it that way, of wheat and rice would be West Africa and Southeast Asia. They are the biggest importers of food grains. Really, when you look at combined exports of wheat and rice together, it says West African countries, and then places like the Philippines, Malaysia, they're second in line, or they kind of go back and forth in terms of who the biggest food importer is, the food grain importer. And with India shutting down wheat exports now, it comes down to rice, and that's what's keeping a lot of those countries afloat. And if they were to turn off their rice exports, good golly, that would be some bad times for a lot of people, a lot of countries that depend on those exports out of India and out of the Black Sea region, because they're all in that little trading zone. They can import out of the Black Sea pretty easily, the wheat, and they can import rice and wheat out of India. Well, you shut off the wheat exports out of India, and you shut off the wheat exports out of the Black Sea, or at least slow them appreciably. Now it comes down to rice, because we've already seen that happen with wheat out of the Black Sea and wheat out of India. So now it comes down to rice as the one grain that's kind of keeping a lot of these countries afloat. And if they did that, that would be catastrophic. Absolutely. I think the Indian government knows that, and they've said as much. They are not going to shut off rice. They're going to keep those exports flowing. I hope they do, because now countries are trying to work with Russia in creating that safe channel of trade for commodities. And I don't think there's anybody that believes Putin's going to allow that to happen. He wants to use hunger as a leverage for his negotiations.
Yeah.
He doesn't want to give up that card. If millions of people need to die so he can get what he wants, so be it. I don't think he cares. So I think it really comes down now to India, and are they going to allow the flow of rice?
Yeah, that's the one thing I'm really paying attention to more than anything. Just is that one little indicator right there, because typically the U.S. we have a fair amount of wheat that we can go export, but with the way things look right now, I mean, we've had some good yields in some good parts of Kansas and good parts of Oklahoma. But we've had, the further west you get into that area, those go from, I went back, from Wichita. So I went back to 4th of July and talked to some folks, and, right around Wichita, it was a mixed bag. You had guys that had 80 bushel dry land wheat. You had some guys that had 15 bushel dry land wheat. It just depended on where they were, and what side of I-135 they were on, and
that's funny.
Yeah. So, and those kind of things right there where you're kind of starting to smash all that together. And what does that look like? It's not a paint in the rosiest picture. I mean, I think it would be good, and from a domestic standpoint, but I mean, the world, supply and those kind of things that come into play. That's that's something I'm paying attention to more than anything, is because just like you said, I mean, that stability, at least when the Arab Spring situation happened and we had, some uprisings in Africa and those kind of things during that time frame, there wasn't already a pinch because of a war in two countries that produce 30% of the world's wheat. Between all those, you didn't have that issue, and now you have that issue on top of what we have going on right now. It's just compiling that pressure even greater.
Yeah, it's hard to look at that situation and then look and reconcile that with the drop in commodity prices that we've seen here recently. And most economists or traders I've talked with believe this is a buying opportunity, because we're not out of this.
Right.
We're not out of the. I think there's a strong likelihood that we may be very short on commodities later this year and heading into next year.
Yep. So it'll be interesting to see what happens going through all that. So, all right. So lastly here, Tanner, let's take a look at what you see happening going through the end of the year. Chairman Powell hasn't really said much about going forward as to what, August interest rates might look like, or September interest rates. They kind of played that by ear, and it feels almost like they're going to take these big jumps and kind of wait and see what happens, and take a jump and wait and see what happens. I guess as you're looking at that, economic situation moving forward, what is your feel for kind of what you see happening? What's your feel moving into the end of 22 going into 23? Do you feel like the Fed's going to be, maybe we're going to hit it one more time and see what happens? Or do you think they're going to sit back and like you just talked about, it's already a crunch out there, and maybe we should take our foot off the gas a little bit?
I think we have to take the Fed at their word. They're going to take it as the data comes in, and they're going to play it by ear. I think they're scared. I think they know that they're behind the 8 ball here, that they should have been raising rates a long time ago. So now they're trying to play catch up. How fast can they play catch up, though, without just cramming it down the U.S. economy or the U.S. consumer? I think, we talked about the jobless numbers are so low right now. I don't think it's even on their radar, even if those start coming up. Really, the story is all about inflation. It's all about trying to get these numbers down from what we were at 8.6 in May. Just phenomenally high numbers. And when you look at the real interest rate, which is what the inflation, real inflation, when you take CPI minus the interest rate, we're still extremely high. And so if you want it neutral, you got to raise interest rates to the level of inflation. That's a long ways to go to get to that level. I mean, that's a pretty far distance to travel in terms of what the Fed is willing and or able to do. I don't think they're going to be able to get there.
Right.
I think they're going to, given the unique economy that we have today, they're only going to be able to go so far. Now, that being said, Chairman Powell has indicated he's a little bit more hawkish. The entire Fed board has indicated they're quite a bit more hawkish than they used to be. They're sufficiently scared. They're not worried about unemployment. They are worried about inflation. They're going to hammer at 75 points in the next meeting. They may do it again, another 75 points in the meeting after that. Then they're going to look at the damage done. And if they can keep doing it, then they're going to keep doing it. And so, I don't know. It'll be interesting to see what effect they have. Because the economy is so different this time. Because inflation this time around is so different. Yeah. So much of it is supply chain driven. And so much of it is driven by the number of workers out there that disappeared, that left the economy. Well, can the Fed really affect, the labor shortage out there? Did they have any impact on that? Did they have any impact on a drought conditions? Do they have impact on Chinese policy as it is with COVID? And those supply chain issues that raise costs on consumers. So much is outside of the Fed's control. I think that's the other thing that has them scared, is that they're late to the party in getting inflation under control, and the tools they got don't fit the problem.
Right.
They have these very blunt instruments for managing inflation, and you can't do anything about China. You can't do anything about these supply chain issues. They can't do anything about the worker shortage. I think they're scared. I think they've found religion. And so I would not be surprised if they really hammer it over the next few months. They're going to raise it 75 points, and then they're going to do it again. They'll look around. Prices are still high, and the unemployment numbers are coming up. They'll do it again until they get those inflation numbers coming down. And I think they're willing to tolerate probably a lot higher unemployment.
Yeah.
That's just my bias.
Yeah, and I mean, it makes sense. If you think about it, it just makes sense what you're saying, because it's logically, that's the tool they have. Like you just said, the tool they have is a blunt force instrument, and it's interest rates, and they keep banging it until they get the scenario that they think they want. And here we go. No different than what Paul Volcker did during the 80s with Reagan's administration.
I think it's worthy noting there, now that you mentioned Paul Volcker, that Jay Powell is a fan of Paul Volcker.
Yes, he is. He is a fanboy.
Disciple of Paul Volcker's.
Yeah.
He's a believer.
Yeah.
And that's what makes me think that they're going to go for it.
Yeah.
They're going to run these interest rates as pretty high.
Yeah.
They may not get it to above inflation, but they're going to try to.
Yeah. I think I think you're right. And so we'll see what happens. It's going to be a fun thing to watch. Not a fun thing to watch, but it'll be an interesting thing to watch, I guess. Probably a better word to use there. But I guess as this all unfolds, we've already seen the stock market come down, housing prices are starting to come down. Wow, if they do what I think they're going to do, this could be bloody. Yep, they could get
all these asset prices were overpriced anyway.
Sure, absolutely. Right. Yeah, going back in just a bigger correction period than anything. So
yeah,
fun deal. All right, Tanner, good stuff as usual, man. Folks want to reach out to you, get more information about what it is you're doing at CoBank. What's the best way to do that?
And just go to CoBank.com, and all of our research is on the Knowledge Exchange tab at CoBank. CoBank.
Right. So tell people what the correlation is with CoBank and AgDirect. How you guys are kind of brothers and sisters in some fashion there.
We're all in the Farm Credit family, so
there you go.
Farm credit leasing tied in there with AgDirect. So it's all farm credit. So support the farm credit family.
Right on. Tanner Ehmke, I appreciate you being on the podcast, man.
Thanks, Casey. We'll see you next time.
Right on, man. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Also go to LinkedIn at Moving Iron Podcast and check this particular podcast out on our YouTube channel at Moving Iron Podcast YouTube channel. So check that out there. More information about what's happening with Moving Iron, go to MovingIronLLC.com. You can also check out what's happening with the Moving Iron Summit coming up here in Nashville, Tennessee, September 6th, 7th, and 8th. You'll see Tanner Ehmke there. and he'll be giving a presentation about what's happening there. So check that out. For more information, send me an email at MovingIronPodcast at MovingIronPodcast.com. I'll be happy to get back to you. So with that, I am Casey Seymour with Tanner Ehmke. Let's move some iron, folks. Out.
Moving iron in the 21st century. Hardware